I hope you're able to see the screen. We start. So we are moving into capital budgeting. We are discussing capital budgeting. We begin by, of course, looking at the outline here. We shall be talking about capital budgeting, the definition, procedures for capital budgeting techniques. Briefly, capital budgeting is the process of identifying, evaluating, and appraising of the firm's investment projects. This process normally involves long-term projects. Projects that usually involve a large upfront outlay, followed by a series of smaller cash inflows. So those are the ones we are talking about here. And we are saying that capital budgeting is generally the largest component of the firm's investment decision. So the firm usually has various decisions. We talked about the financing decision, working capital management decision. We talked about dividend decision plus the capital budgeting decision. So this one is one of those that is generally large when it comes to finance in general. The capital budgeting decision is the largest component when it comes to investments. Now, our major discussion will center around the two types of investment techniques, or the techniques that we use in evaluating and appraising projects. So we shall be talking about the non-discounted cash flow techniques and the discounted cash flow techniques in detail. Within the non-discounted cash flow techniques, there are mainly two. So we shall be talking about the net. Okay, let me start with the payback period method and the accounting rate of return. Accounting rate of return method, ARR. This is PBP. So these are the non-discounted cash flow techniques, meaning that we are not going to use discounted cash flows, or we are not going to discount the cash flows under these two methods. And then we have, for the discounted cash flow, we shall talk about the net present value method. Net present value method, NPV. Shall talk about the internal rate of return method. Internal rate of return method, the IRR. Then we shall talk about the discounted payback period method. Then number 6, which I will put around here, is the profitability index. Okay, let me just fit it down here. Profitability index. Profitability index method. So that one has 4 of them that we are going to discuss in detail. So we shall begin with the net present value method. Net present value method. Sorry. Let's start with the payback period. Just keep it simple. Let's start with the payback period. Payback period method. Let me just share my screen here. Payback period. I have my screen here. This one, payback in itself refers to the time it takes the cash flows from a capital investment project to equal the outflows. We usually express this one in number of years so that we get to know how many years it will take you to get back your money when you invest. The payback period is the length of time before the cash inflows from your investment give you back the original investment. Now, payback period is a it's the simplest, I should say, the simplest method of investment appraisal. So because of its simplicity, we often use it as the first screening method in investment appraisal. So all investments are subject to the payback period assessment. And the question is always, when do I get back my money? So that's the payback. And you continue by saying that this means that when a capital investment project is being considered, the first question is, how long will it take to pay back the cost, the investment? How long will it take us to get back the investment, the original investment? Usually, organizations have their own payback period, but in most cases, because we are talking about huge projects, it is quite a big period. So any project that does not satisfy our payback period is going to be rejected outrightly. For example, if we expect to get back our money in 5 years, and then you bring us a project that gives back our money in 20 years, we shall not accept it. Then again, we are saying that when you're using the payback period, you need to use it together with another method, because the payback period alone may not be satisfactory. As you can, of course, as we have mentioned, it is a non-discounted cash flow technique. So it is used together with others that we are going to discuss. So as I've mentioned, the acceptance, rejection of a project will be based on the number of years we are going to get back our money and our policy on investment. If a project will take us a long period of time to get back our money, that project is going to be rejected. We shall look at 2 scenarios, one where we have constant annual cash flows and another one where we have non-constant. So let's begin with the constant annual cash flows. When it comes to constant annual cash flows, where you're getting the same money every year, the payback period is calculated using this formula. We get the initial outlay divided by the annual cash flows. So we are saying that where the project generates constant annual cash flows, the payback period is computed as per this formula. So we are not writing it now because we shall still use it in our activity. So I'll use a simple activity here. And of course, we shall consider project A, which requires an investment of 50 million. Now, this project gives us 12.5, 12.5, 12.5 million cash inflow for 7 years. So what is the payback period? Now, since we are getting the same amount of money every year, we shall calculate the payback period as per the formula on the previous slide. So the payback period in these circumstances will be the initial investment or outlay for that matter, divided by the annual cash flow. So we have invested 50 million and the project is giving us 12.5 every year. So when do we get back our 50 million? After how many years? Quickly do the math there. Give me the answer. All right. It's 4 years. Yeah, this is 4 years. Now, let's talk about the 4 years, friends. Do you think this project will be accepted? Do you think this project will be accepted? Yes, the answer can be yes. The answer can be no as well. You can only say yes if you're sure about the company's payback period policy. You get it? You must be sure about the company's payback period policy. That's when you can say yes. But ideally, we see the project is a viable one because it pays back within the life. After 4 years, you get your money. But we don't know. These people could want their money in 2 years. Yes, the project will go for 7 years, but the company may want its money in 2 years. You get it? So this project will be rejected. You see, it really depends on the payback period policy. Okay? That answer depends on the payback period policy. Because of the fact that companies want back their money in a certain period, which we don't know in this case. But ideally, if we are to talk about the life, does it pay back within the life? Yes, it does. It pays back because there are some projects which may not pay back in the life. You get it? So that is what we shall use here. We shall say, we shall say that the project pays back. Okay, the project, let us write and say that the project is financially viable because it pays back the initial investment in its life. However, on the side of the company, we are not sure since the company has not told us their payback period policy. Their payback period policy. We don't know. They may want their money back in 1 year or even in 2 years or 3 years. We can only say yes if the payback period policy is 4 years. You get it? So that is the note you should put. Next, we look at activity 2, where, of course, this is what we have done. Uneven annual cash flows. Now here we're saying that where the project generates uneven cash inflows, the payback period can be found by adding up the cash inflows until when the total is equal to the cash, until when the total is equal to the initial cash outlay. Until when the total is equal to the initial cash outlay. Okay. So we are going to make use of this question. We have two projects A and B, which are under consideration, each with a cost of 10 million. You have been provided with information regarding the two projects. It is management's policy to accept projects that recover the initial investment after 3.5 years. So you have project A and project B. I don't know whether we should really write this. I don't know. What do we do? Okay, you don't need to write this because I have this information in the solution. Let's not write to take a lot of our time. So in this case, this is a more realistic scenario. This is a more realistic scenario because the project is giving us, the two projects are giving us different what? Different values, not the same like the other first one. So we are going to calculate the payback period for each project, and then we comment on the overall acceptability of the two projects. We are going to compute the payback period for each project, and then we comment on the overall acceptability of the two projects. So have we been told the payback period policy? Yes, it is here. We only accept projects that recover the initial investment in 3.5 what? In 3.5 years. We only accept projects that pay back within 3.5 what? Within 3.5 years. And that is the policy. So I'll give you just some 3 minutes to read through the question. Just read through so that, but don't write, just read through. In a few minutes, then we start on it. The screen. So here we are. Here we are, right here. So what are we saying? We are saying that under this approach, where a project generates uneven cash inflows, the payback period can be found by adding up the cash inflows until when the total is equal to the initial cash outlay. So we arrange our two projects in two columns like this. Then, of course, we bring our year one. Year one project A gives us 5,000 cumulatively. So here I have the annual cash flow as one column, and then the cumulative cash flow in the next column. So I have 5,000 coming in cumulatively. That gives us 5,000. Project B gives us 4,000. Cumulatively, it comes to 4,000. Then when we go to year number two, project A gives us a 4,000, which cumulatively comes to 9,000. Project B gives us 3,000, which cumulatively comes to 7,000. Remember, we had the 4,000 in year one. Now we have received the 3,000 in year two, which is 7,000. Now, what are we aiming at? We are aiming at the initial investment of 10 million. You remember? We invested in 10 million. So none of these has given us a 10 million. Let's go to now we move to year number three. Year number three, project A gives us 1 million. When we add 1 million to 9 million, we get the 10 million. Remember, we invested 10 million, so it looks like project A has given us the initial investment. Project B in year three gives us 2,000. Cumulatively, that comes to 9 million. Project B has not yet paid back. So we shall say the payback period for project A is 3 years. Okay, we have already received our 10 million that we invested. Now, since we have not yet received the initial investment from project B, we move another year, which is year four. Year four, project B now gives us the 1 million, which cumulatively comes to 10 million, meaning that in year number four, project B gives us the initial investment. Therefore, the payback period for project B is 4 years. Now, which of the two projects is the best? That should be project A, because project A pays back early. That's number one. Number two, it pays back within the payback period of 3.5 what? Of 3.5 years. So this is the solution to our very first activity, which I think you might need to write down or take a screenshot. I don't know where you're going to get the solution, but you need to take a screenshot. So let me give you time to take a screenshot or to write this down. If everything is okay, then we shall proceed. All right, can we proceed? Can we proceed? Edward, Farida? The interpretation is right here. We are saying that project A will take 3 years to pay back the initial investment, while project B will take 4 years to pay back the same initial investment of 10 million. Project A shall be accepted since it pays back within the company's acceptable payback period of 3.5 years. Project B shall be rejected since its payback period of 4 years exceeds the company's acceptable payback period of 3.5 years. So basically, that is the interpretation. Sorry, it went off. Let me also share this part of the interpretation. This one here. Can look at it in half of a minute. We move to the next one. So the accounting rate of return shall be defining it and also looking at the formula, advantages, limitations. So the accounting rate of return refers to the ratio of average annual profit after tax to the average outlay on the investment. It refers to the ratio of the average annual profit after tax to the average outlay on the investment. This one has a formula, okay? This one has a formula, and this is the formula that we shall use in calculating the accounting rate of return. So we get the average annual profit after tax, which is our numerator, and the denominator is the average annual investment times 100, of course, to get the percentage. So this formula, we are going to find it ahead. It's also on the slide I'm going to share with you. Now, when it comes to the average annual profit after tax, we get the total profit after tax divided by the project duration. We get the total profit after tax divided by the project duration. Shall see that as well. Then for the average annual investment, it has this unique formula because when you say average, you divide by the number. But for this one, we are dividing by 2. Okay, we are dividing by 2. So we get the initial investment plus the residual value divide by 2. Initial investment plus the residual value divided by 2. So we are going to use all this in our practice question. So how do we accept, how do we reject the project? For the payback period that you have just covered, we have seen that we reject the project if it doesn't pay back within the agreed payback period policy. Now, when it comes to the accounting rate of return, a project is accepted if its accounting rate of return is greater than the project's required rate of return. A project is accepted if its accounting rate of return is greater. So it means that the examiner has to give you the company's or the project's required rate of return. That our project, the required rate of return maybe is 15%. So it means that the accounting rate of return should be greater than 15%, which is the required. So we shall accept a project with a greater accounting rate of return. If it is less, then we shall reject the project. Okay, we are going to use this simple question here, activity. A company has a target rate of target return on capital employed of 20% for its capital investments, and is now considering the following project. The investment in the project is 80 million. Estimated life is 4 years. We are given the profits for the next 4 years. 20 million year number 1, 25 million year number 2, 35 million year number 3, and then 25 million in year number 4. Then we are told that the capital asset would be depreciated. That asset, this machinery, this asset here, we are told would be depreciated at 25%. You know, accountants, since we're talking about the accounting rate of return, depreciation does not miss out. So we are going to depreciate the asset at 25% of its cost each year. And then the asset has a nil residual value. The asset has a nil residual value. So we shall assess whether the project should be undertaken or not. Should the project be undertaken or not? All right, we are not writing the question. We're just going to go straight to the solution. For any other information that you might need, I'll be switching over the screens so that you can pick up those details. All right, so let us calculate our accounting rate of return. Okay, we begin by, we shall do it stepwise. We begin by appreciating the formula, which is this one here, where we're saying that the accounting rate of return is the average annual profit after tax divided by the average annual investment. So the average annual profit after tax is going to be our step 1. Then our step 2 is the average annual investment. So we're going to do it stepwise. So as I've mentioned, step 1, we calculate the annual profit after tax. How? We shall get the profit before depreciation, which is given in the question. These are the profits given. Then we charge depreciation. And then we shall have the profit after tax. So how much is the depreciation? We are told in the question that we shall depreciate this asset at 25% on cost. So 25% on cost is straight line, not so? And what is 25% of 80 million? 25% of 80 million is about how much? Is 20 million, okay? So basically, if I just insert our working one here, we have working one, the depreciation is 20%, 25% of 80 million, which is 20 million. So that is 20 million, 20 million, 20 million, 20 million everywhere. So this is profit before depreciation. So if we remove depreciation, we end up with year 1, that's 0, year 2, that is 5 million, year 3, that is 15 million, year 4, that is 5 million. So all in all, the total comes to 25 million. So it means that in our formula here, the numerator is 25 million. Oh, sorry. We haven't yet determined the average. We need to get the average first. But before we get the average, remember this is the total annual profit, but now we need to get its average by dividing by the number of years. So before we go there, I'll give you some time to finish up with this. Then we can get the average to arrive at the annual profit, average annual profit after tax. All right. Let us continue. So the average profit after tax, we shall get the total profit of 25 million divided by 4 years. This gives us about how much? That gives us about how much? Gives us about how much? Anybody the calculator there? 6.250. Good. 6.250. So that will be the numerator. Now we look for the denominator. In our step number 2, we are determining the average annual investment using our formula here. Getting the initial investment of 80 million plus the residual value of 0 divided by 2. That comes to 40 million. So at the end of the day, the denominator and the numerator should be giving us the accounting rate of return. Therefore, our accounting rate of return is the 6,250 divided by 40 million times 100%, which gives us about how much? Which gives us about 15.6%. 15.6%. So do you think we shall accept this project? Do you think we shall accept this project? Okay, this project will not be accepted because our target was 20%, right? Our target was 20, I think 20%. Yes, our target was 20%. So this project is not going to be accepted because the accounting rate of return is lower or less than the target required rate of return. So before we summarize that, you can use 1 minute to do this quickly. This is very little. 1 minute is enough. Then we move to the conclusion. So we conclude here by determining the accounting rate of return, which you have done. Our analysis is that the project would not be undertaken because it would fail to yield the target return of 20%. Basically, the accounting rate of return is a signal of how much return the project will give. So if you have a target of 20 and it's giving you 15, then it means you're not going to meet the target. All right. That is your accounting rate of return. We have a further discussion here in regard to dealing with mutually exclusive projects. And here we're saying that the accounting rate of return method of capital investment appraisal can also be used to compare 2 or more projects which are mutually exclusive. The project with the highest accounting rate of return would be selected, provided that the expected accounting rate of return is higher than the company's required rate of return. So the project with the highest, first of all, if 2 projects are being compared and one beats the required rate of return, then that one will be taken. If both of them beat the required rate of return, we shall take one with the highest accounting rate of return. The limitations are also given here. One is that the accounting rate of return method of capital investment has a serious drawback, that it does not take account of the timing of the profits from an investment. It doesn't tell us, of course, we know the profits are calculated at the end of the year, but at what point do these profits come in? Whenever the capital investment is invested in a project, whenever capital is invested in the project, money is tied up until the project begins to earn profits, which pay back the investment. Money tied up in one project cannot be invested elsewhere or anywhere else until when the profits come in. Management should be aware of the benefits of early repayment from the investment, which will provide the money for other investments. There are a number of other disadvantages, like, for example, it is based on accounting profits and not cash flows. Most investors want to hear about cash flow, not profits. Accounting profits are subject to a number of different accounting treatments. We have profits after tax, profits before tax, operating profits. So which profit are we talking about here? It is a relative measure rather than an absolute measure, and hence takes no account of that investment. It takes no account of the length of the project. It lacks the payback, like the payback method, it ignores the time value of money. Advantages are also there. One is very quick, as you have seen. We can quickly calculate it. And even this information is available because the profits you can determine, the accountants can give us the profit, the value of the asset, the depreciation rates, we have it already. The accountant can calculate that. So the information to use is readily available and is quick, simple to calculate. It involves the familiar concept of percentages, because if you compare one percentage with another, it makes more meaning, really. The fact that it gives a relative measure means that the accounting rate of return means it is easy to compare two investment options. It looks at the entire project life, not just pieces of the project. That is the other advantage. So those are the two non-discounted cash flow methods that we have discussed: payback period and the accounting rate of return. In the next or in the remaining minutes, we are going to discuss the discounted payback period. The discounted investment appraisal methods, including the net present value, internal rate of return, profitability index, and the discounted payback period. I'll record that session separately. So let me first stop this, then we move into the next segment.